Hello, and Happy New Year from us here at Gemini Asset Management. We've seen some excellent performance from asset markets in the last quarter of 2023, so let's dive in and get to the bottom of it all. In today's briefing, we'll touch upon equity market performance, bond market performance, and the big ticket macro levers that have been driving it all. Figure 1, on screen now, shows the performance of various major equity markets over the last quarter, and as you can see, it's been a corker in most cases. US equities performed exceptionally in the last quarter, posting positive returns of 7.2% in one quarter. The technology sector was the largest contributor to this, and it produced more than 3.3% of the 7.2% generated in total. This is all a continuation of the trend we've seen so far this year, as growth-style equities have tended to outperform. Remarkably, this wasn't even the best performing equity index during this time, with European equities pipping the States in December and ending the quarter 7.6% up. Much of the rally was on the back of expectations for interest rates to be cut sooner than the market had originally expected in 2024, as data releases for the European economy again look relatively poor. This has historically spurred the central banks to cut interest rates and attempt to stimulate economic growth at times when it's looking like in the future it might be relatively low. Chinese equity also had a tricky time during the quarter, and this proved to be a drag on Asian equities in general. Concerns still lingered for China's property sector, but there are now signs that the CCP's economic stimulus is starting to find some traction, something which may benefit Chinese and other emerging market assets in general. Now, equities are only one side of the story. Figure 2, on screen now, shows the performance of various bond markets over the last quarter, and what a welcome change this has been. High-yield bonds perform the best, with the returns of these typically being a little bit more risk-on and equity-like. They've generated 6.4% in the quarter, and for a bond, that's definitely nothing to be sniffed at. Even the global aggregate index, which consists of bonds with some of the highest credit ratings possible, typically a slow mover in terms of performance, managed to return 3.5% in the quarter. This is an exceptional turnaround in fortunes. Finally, let's move on to why on earth both equity markets and bond markets performed so brilliantly in the final quarter of the year. Essentially, they all benefited from increased levels of discussion surrounding the potential peak in interest rate hiking cycles, following on from some big wins to bring down inflation in the final quarter of 2023. Jerome Powell, the chairman of the US Federal Reserve, hinted that the rate hiking cycle may well be over, stating that we're likely at the near peak rate for this cycle. This is as clear of an indication as we've been given by the most impactful central bank in the world, that interest rates may be expected to come down in 2024 if inflation continues on its current trajectory, downwards. Figure 3, on screen now, shows a change in expected interest rates from the end of quarter 3 to the end of quarter 4 in 2023 for the major developed regions. The chart on the left shows the expected interest rate data points as at the end of Q3, and the chart on the right shows the same expected interest rate data points as at the end of Q4. As you can see, expectations shifted drastically, and at the end of Q3 2023, shown in the chart on the left hand side, the UK's interest rate, shown by the blue line, was expected to be roughly 5% 1 year on, so at the end of quarter 3 in 2024. Following some big wins in the inflation battle and the more dovish tones from the central banks, the UK's interest rate is now expected to be below 4% by the end of Q3 2024, shown by the blue line on the right-hand side. This was huge for bond markets, as investors finally felt a modicum of certainty that rates will start to fall in 2024, and this necessarily then sent prices flying in bonds. For equity markets also, the risk-on sentiment returned. Falling interest rates are typically good news for many different equity sectors, such as technology and industrials, and have responded accordingly in the final quarter of the year. With interest rates expected to fall more drastically than had previously been forecast, these sectors performed brilliantly, with the technology sectors contributing to roughly half of the overall total positive performance from the global equity index. Now, it's important to stress that even though some battles may have been won, it does not yet mean that the war against high inflation is over, and it comes with the need to tread a little bit cautiously. While central banks may have indicated that there'll likely not be any more interest rate hikes, their forecasts have been incorrect in the past too. Much of it will depend on the resilience of the global economies, and if the economies remain strong and inflation proves to be more stubborn than we're currently expecting, we may yet see interest rates lingering a little higher than we as investors would like. This uncertainty is exactly why we ensure our portfolios are effectively diversified, and they're not reliant on one binary outcome or the other to meet either their investment goals or their risk goals. That's all from us here today at Gemini, and if you have any other questions at all, please feel free to contact your advisor. All that's left to say is that we hope you've had a wonderful Christmas and to bring on 2024. Thank you.